The S&P 500, Dow, and NASDAQ all closed down Tuesday after an initial opening rally. With Wall Street's roller coaster ride continuing, we wanted to take a look at why some experts are warning we could be heading to a bear market across all major indexes and what that means. A bear market is when a major stock market index like the S&P 500 falls 20% or more for a sustained period. It's called a bear market because stocks are retreating like a bear does when it hibernates. A bull market, by contrast, is when stocks are surging. It typically lasts multiple years, whereas the average length of time for a bear market is around a year. As of now, the S&P 500 and Dow Jones Industrial Averages have narrowly avoided officially entering a bear market. The S&P is down 19% from February. The Dow is down 16% from its high in December. But the NASDAQ, which is dominated by tech companies that are particularly exposed to rising tariffs, fell into bear market territory last Friday. The U.S. economy is currently not in a recession, though there are concerning signs from consumer spending and other economic metrics. Typically, a recession means 2 periods of back-to-back gross domestic product decline. The 2 most recent quarters showed GDP growth, and the U.S. added more jobs than expected last month. Positive economic signs there, but if bear market conditions continue, it could be a sign that the U.S. is heading for a recession, or at least increasing its risk of doing so. The president and CEO of the American Apparel and Footwear Association is warning the Trump administration's tariffs, set to take effect on Wednesday, will have a major impact on consumers. Vogue is reporting that most fashion brands, especially those that work with China, which faces a 104% tariff, will, quote, have no choice but to raise prices, likely around 15% on average. Author Hilary Milnes writes that vendors and manufacturers will also be forced to restructure their supply chains, which could end up putting them out of business entirely. Hilary Milnes joins me now. She's the America's editor for Vogue Business. Thank you, Hilary, for being here. The stock market continued to fluctuate on Tuesday, as I'm sure you saw. Companies like Nike, American Eagle, Gap, Ralph Lauren saw losses. What challenges, though, do smaller businesses face compared to larger companies like Nike or Gap when it comes to these tariffs?
Yeah, of course. I think in all of these events, it is the small businesses that bear the brunt. They don't have the deep pockets to fall back on whenever these times are up against the wall, and they have razor thin margins, and they don't have the bargaining chips that big brands have with suppliers, with retailers. And we've heard from sources that this is going to be a major survival test for smaller brands this year. There could be job losses. There are likely to be changes to their supply chains and their retailer relationships. And they could, we could even see some of these brands going out of business this year if, things continue as they are and they don't let up.
So the CEO of Cytex, a denim manufacturer based in the U.S. and Vietnam, told you it is not possible to move 100% of the company's operations in the U.S. Why is that? And what concession is he asking of the president?
Yes. So the U.S. is not currently equipped to manufacture at such a capacity if all fashion brands in the U.S. are forced to manufacture domestically. We don't have the capabilities, the labor, the materials. No matter what, even if you are manufacturing in the U.S., you are going to be sourcing a lot of your materials abroad, and costs are just going to be so high that the customer is not going to be able to afford it. What he asks of the administration is for companies that are currently manufacturing domestically to be able to avoid some of these tariffs that are on materials, so that they are exempt from tariffs that would hit some of these, the metal for the zippers, anything like that, that is going to hit the supply chain across the board. But he acknowledges that that's likely a long shot.
What options are fashion companies exploring to offset the effects of tariffs on prices?
So we've heard from fashion brands that they are constantly in communication with their suppliers to try to negotiate costs. We've heard that some are even holding cargo ships and not importing things into the U.S. right now in order to wait it out. Obviously, that can only last so long. And they are also looking at how they can absorb some of the hit into their own margins. But of course, they are also considering raising prices on consumers, and some prices on the sales floor could change as soon as this week.
What should the average person watching take away from this? I mean, if they need to buy some new clothes, spruce up spring or summer wardrobes, how much more of their budget do they need to set aside for that?
We've heard that there's a scale, I think, on the soft luxury side, because a lot of that is coming from the EU. Prices are going up between 3 to 6%. If you are in the market for watches, hard luxury is expected to go up a little higher in the high single digits. And then on average, for brands that are more exposed to the Asia supply chain, that could be as much as 15%. There's a couple options. I think we're going to see more customers shopping secondhand, shopping resale platforms and thrift sites, because those are going to be more insulated from tariffs. These are already goods that are in the U.S., already made. And if you're a luxury consumer, you're likely going to wait for your trip abroad over the summer in order to buy those luxury goods. But I think, when you prices going up across the board on everything from groceries, I think we can expect people to be buying less, and that consumer confidence is really a big part of what's contributing to the stress and anxiety that retail executives are dealing with right now.
Hilary Milnes, thank you for your reporting and for joining us.